The stock market continues to evolve, and today we're diving into the liquidity, cash flow, and debt profiles of Apple and the other magnificent seven: NVIDIA, Meta, Google, Tesla, Microsoft, and Amazon. This analysis is based on data from alphastockai.com. For a deeper dive into these financials, visit their platform. Apple's liquidity metrics over the last 8 quarters show a mixed picture. Its current ratio has ranged from 0.87 to 1.07, which is lower than NVIDIA and Meta, whose liquidity positions remain far stronger, averaging 3.5 and 2.7, respectively. A low current ratio suggests Apple operates with tighter short-term financial flexibility. The quick ratio tells a similar story, fluctuating between 0.83 and 1.02, again significantly lower than its peers. However, Apple's negative cash conversion cycle, which has remained between -26 to -46 days, highlights its superior operational efficiency in turning inventory into cash flow faster than competitors like NVIDIA and Meta, which have positive CCC values. Shifting to cash flow, Apple continues to showcase its strength in cash generation, but its competitors are not far behind. Over the last 8 quarters, Apple's operating cash flow to sales ratio averaged 29.6%, while NVIDIA and Meta outperformed at 47.9% and 52.7%, respectively. This suggests that despite Apple's strong brand and product ecosystem, some of its competitors are converting sales into cash even more effectively. Apple's free cash flow per share has remained stable, averaging $1.68, reinforcing its ability to generate shareholder value consistently. Meanwhile, its capital expenditure coverage ratio surpasses Microsoft and Amazon, but lags behind NVIDIA, which remains the clear leader in this category. Dividend investors should note that Apple maintains a lower payout ratio at 15.4% compared to Microsoft's 24.7%. Now let's talk debt. Apple's debt ratio has been trending downward, moving from 33% to 28% over the last 8 quarters, a sign of financial discipline. However, it remains higher than Google's remarkably low 7%. The debt-equity ratio, a key indicator of financial leverage, has hovered around 1.7, signaling that Apple relies more on debt financing than peers like NVIDIA and Meta, whose ratios remain significantly lower. The total debt-to-capitalization ratio for Apple stands at 60%, a stark contrast to Microsoft and Google, both of which maintain levels below 30%. A major concern, however, is Apple's recent trend of reporting zero interest coverage, which raises questions about its ability to comfortably manage debt costs in the near term. So, where does this leave investors? For the long term, Apple's ability to maintain strong free cash flow, a negative cash conversion cycle, and consistent profitability makes it a compelling investment. However, short-term investors should take caution, as its declining liquidity ratios and debt management trends suggest potential challenges ahead. NVIDIA and Meta currently hold stronger liquidity positions, while Google and Microsoft maintain more conservative debt profiles. If you're looking for a financially stable stock with operational efficiency, Apple remains a solid choice, but if liquidity and low debt burdens are your priority, companies like Google and NVIDIA may offer better risk-adjusted returns. As always, stay informed, analyze the data, and for a more comprehensive breakdown of these financials, visit alphastockai.com.